Hey everyone, welcome back to Corporate Decoder, the place where we try to untangle the financial mysteries of big companies. And let me tell you, this latest report from Transit ProTech Incorporated has some seriously interesting things going on, like a financial puzzle with a few missing pieces. Imagine opening up a company's report and seeing this big document. That is what we've got here from Transit ProTech Incorporated. It is a quarterly report, meaning it gives us a snapshot of how they're doing financially over a 3-month period. And this one covers the end of 2025. They're telling us about their business, their money situation, and what could happen in the future. Now, right at the start, they have this section talking about forward-looking statements. Basically, this is the company's way of saying, hey, we're going to talk about our hopes and plans for the future, but things might not actually turn out that way. They're trying to protect themselves from being blamed if things go differently than they expect. It is a pretty standard bit of legal language. But it is important to remember that the future is always uncertain, even for companies with big plans. Something else that stands out is this forward stock split they mention. What does that mean in simple terms? It is like taking a pizza and cutting it into more slices. A 20-for-1 stock split means that for every 1 share of stock you owned before, you now own 20. This makes the price pair look much lower, and it can make the stock seem more affordable to smaller investors. They did this back in October of 2024, and all the numbers in this report have been adjusted to account for it. Alright, let's dive into the numbers themselves. This is where things get really interesting. We're looking at their balance sheet, which is like a financial snapshot of what they own and what they owe at a specific point in time. They show us numbers for the 31st of December 2025 and for the 30th of September 2025. First up, cash and cash equivalents. This is the money they have readily available. On the 31st of December 2025, they had about $26,053. Now compare that to the 30th of September 2025, where it was $26,886. So their readily available cash went down a little bit. That is not a huge amount, but for a company looking to grow, you always want to see that cash pile growing or at least staying stable. Then we see deposit and other receivables net. This is money that is owed to them or money they've put down as a deposit. This number jumped up significantly from about $9,772 to $13,376. This increase might mean they are owed more money than before, or they've put down more deposits. It is good to see an increase in what is owed to them, assuming it is collectible. When you add up all their assets, meaning everything they own, their total assets were $187,511 on the 31st of December 2025 and $188,423 back in September. So their total assets decreased slightly. That is not necessarily a bad thing, but it is a sign of a small dip in their overall holdings. Now let's look at the other side of the balance sheet, the liabilities. Accrued expenses and other payables is a big one. This is money they owe to others that hasn't been paid yet. This number grew quite a bit from $362,735 to $411,511. That is an increase of roughly $48,776. Companies often have growing payables when they're expanding, but it also means they owe more money. And what about amount due to related parties? This is money owed to people or companies that are connected to Transit ProTech, like their owners or business partners. This also went up significantly from $494,083 to $588,906. That is an increase of almost $95,000. This tells us they are borrowing more money from people connected to the company, which is a common way for startups to get funding. When you sum up all their debts, their total liabilities went from $993,820 to $1,131,407. That is a chunky increase of about $137,000. So while their assets dipped slightly, their debts went up quite a bit. And then we see total shareholders deficit. This is essentially their net worth, and in this case, it is negative. It went from a deficit of $805,397 to a deficit of $943,896. This means that what they owe is much more than what they own. For a company that is trying to grow, this is a really important number to watch. A large negative number here means they have a lot of ground to cover before they become profitable. Now let's look at their statement of comprehensive loss. This tells us about their performance over a period, like their profits and losses. Their revenue, which mostly comes from related parties, was $70,500 for the 3 months ending the 31st of December, 2025. This is down from $105,296 in the same period in 2024. So their income from these related parties has decreased. Their gross profit is the revenue left after you subtract the direct costs of making their product or service. This also decreased from $94,393 to $62,477. This drop in gross profit reflects the lower revenue and the cost of sales remaining somewhat consistent. And here is a big one: operating losses. This is the loss they have from just running their core business operations. It increased from $82,081 in 2024 to $132,705 in 2025. This means they're losing more money from their day-to-day business. When you add in other income and expenses, this leads to a loss before income taxes. This loss grew from $94,877 in 2024 to $130,902 in 2025. So as expected, their losses are increasing. And that brings us to the net loss. This is the bottom line. It went from a loss of $94,877 in 2024 to a loss of $130,902 in 2025. This tells us that the company is still losing money and the losses are getting bigger. Now, this foreign currency translation adjustment might sound technical, but it is important. It is about how the value of money in different countries changes. In 2024, they had a positive adjustment of $9,277, but in 2025, it was a negative adjustment of $7,597, meaning the value of their foreign assets or earnings decreased when converted to US dollars. So their total comprehensive loss also increased, going from a loss of $85,600 to a larger loss of $138,499. This just reinforces the picture of a company that is currently losing more money than it is making. Let's look at the shareholders' deficit statement. This is where we see how the owner's stake in the company has changed. The numbers here show the same trend we've seen. Their accumulated deficit at the end of December 2025 is a hefty $1,898,561, a big jump from the $1,767,659 deficit in September. This is essentially accumulated losses over time. Looking back at December 2024, the numbers are a bit different because of that stock split we mentioned. But even with the adjusted numbers, you can see the trend of increasing losses and a growing deficit. What is notable here is the stock split line item showing a positive impact on common stock and a negative impact on paid in capital in 2024. Which is a technical accounting entry reflecting that split. Now, let's talk about cash flow. This statement shows how cash is coming in and going out of the company. It is crucial because, as we've seen, they have a pretty big deficit. Starting with loss before income taxes, it is $130,902 for the 3 months ending December 2025, which matches what we saw on the loss statement. The most important part here is net cash used in operating activities. For the 3 months ending December 2025, they used $85,524 in cash just to run their operations. This is a significant amount, especially when you consider their available cash is only around $26,000. In the same period in 2024, they actually generated $38,770 in cash from operations. So that is a noticeable shift in the wrong direction. Under cash flows from financing activities, we see they provided $92,288 in cash in 2025. This is mostly from money coming in from related parties. In 2024, they used $60,110 in cash for financing. This shows that they are relying heavily on money from their related parties to keep the lights on. When you put it all together, there was a net decrease in their cash and cash equivalents of $833 in 2025. This might not seem like much, but remember, they are already starting with a very small amount of cash. In 2024, they had a bigger decrease of $12,063. And at the end of the period, the 31st of December 2025, they had $26,053 in cash. This is a very small amount for a company that is trying to operate and grow. It raises a serious question about their ability to continue as a going concern. This section talks about how the company was formed and its subsidiaries. They're based in the United States and Hong Kong, and they sell hardware and software for things like driver management systems and rail floor detection. It is good to know what they do, but the financials are telling a different story right now. This is a pretty stark warning. They are saying right here that based on their current finances, there is serious doubt they can keep operating for the next year. This is a red flag for any investor. This part is all about the accounting rules they follow. It explains things like how they recognize revenue from their licensing agreements and how they deal with foreign currency. They mention fixed fee license revenue. This is where they earn money from allowing others to use their software or technology for a set price. They say they recognize this revenue over the contract term. Then there is royalty revenue. This is when they earn money based on how much others sell using their technology. They have a challenge here because they don't always get the reports from their licensees quickly enough to know the exact amount, so they have to estimate. This is a common issue in businesses that rely on royalties. Looking at their schedule of accrued royalty revenue, for the 3 months ending December 2025, they had $70,500 in fixed fee license revenue and no royalty revenue. This is the same as the previous year for the fixed fee, but the absence of royalty revenue compared to $34,796 in 2024 is a point to note. Under income taxes, they state clearly that no provision of income tax for the 3 months ended the 31st of December 2025 and 2024. This means they are not paying any income taxes. This is usually because their losses are so large that they don't have any taxable income. The property and equipment net shows their investments in things like computers and machinery. They've invested $26,015 in this area by the end of 2025, up from $18,682 in September. This indicates some investment in their physical assets. Their leases section discusses how they account for office space or equipment they rent. They adopted new accounting rules, which means they now have to show lease liabilities on their balance sheet. The present value of operating lease liabilities is $123,117, split between current and non-current portions. This shows they have ongoing commitments for rented spaces. This is the section detailing deposit and other receivables net. Here we see that rental deposit is $5,475. The others category takes up the rest, growing from $4,413 to $8,017. This section also reiterates that their allowance for credit losses is minimal at $116. This is a really crucial part of the report, especially for a company of this size. Related party transactions refers to any business deals between the company and its owners, management, or other affiliated entities. It is important to examine these closely because they can sometimes indicate how the company is being supported or how profits are being moved. Here, they explain a deal with BA Technology Inc. Mr. Windu, who is a key figure in Transit ProTech, is also connected to Bybee. Bybee has been paying for Transit ProTech's operating expenses, and Transit ProTech is supposed to pay Bybee back. They even have a loan agreement for up to $1 million. The outstanding loan balance from Bybee was $177,552 in December 2025. This shows a growing debt to a related party. They also have a license agreement with Shenzhen Bybee Internet Technology Company Limited, also connected to Mr. DoYou. This agreement grants SEB the rights to use and sublicense Transit ProTech's intellectual property and products in mainland China. It involves a fixed license fee and royalties. This is where we see the revenue from that license agreement. They recorded $70,500 in fixed fee revenue for both 2025 and 2024. However, the royalty revenue from this agreement dropped to zero in 2025, down from $34,796 in 2024. This is a significant decrease in a revenue stream. This table summarizes all the money flowing between Transit ProTech and its related parties. For the 3 months ending December 2025, they had interest expenses to Bybee of $2,535 and fixed fee license revenue from SEB of $70,500. Notice that royalty revenue from SE Bybee is zero for 2025, and here we see amount due to shareholders. This includes people like Wei Hongdu and Liu Shi. The amounts owed to them have increased from $3,395 to $7,873. This section shows amounts owed to entities like Bybee and Bybee, which have grown substantially. Bybee is owed $183,405 and Bybee is owed $388,208, showing a significant increase in their reliance on these entities for funding. Now we're getting into management's discussion and analysis. This is where the company's leaders explain in their own words what the numbers mean. They describe their business as developing software for detecting faults in railroad tracks and other rail safety systems. It sounds like innovative work. Mr. DoYou, their main shareholder and leader, has been doing this kind of work for over 5 years. This part explains that they have subsidiaries in Hong Kong and China, which is how they do business in those regions. It also clarifies the relationship between Transit ProTech and Bybee, highlighting that their founding shareholders own both entities. This section directly compares their financial performance for the two periods. It reiterates the revenue numbers we saw earlier and the increasing operating losses. They explain their revenue comes from the licensing agreement with BYD, and it is a portion of that annual fee. They openly admit their net loss and explain it is due to marketing expenses and a lack of significant revenue. This is a very honest, if somewhat concerning, statement. This is the section about their ability to pay their bills. Liquidity is all about how much cash they have available. They are very clear here. Most of their expenses have been paid for by money borrowed from BYD, which is controlled by their main shareholder. They also mention some money from a private stock sale. This highlights their dependence on related party funding. They detailed the loan agreement with BYD, a $1 million loan at 7.5% interest. As of December 2025, they had borrowed $180,419, including interest. This is a concrete example of their ongoing need for financing. This is the critical takeaway. They have very little cash, a huge amount of liabilities, a big working capital deficit, and a massive shareholder deficit. All these factors point to serious concerns about their ability to stay in business. They are completely dependent on raising more capital. They explain that the cash used in operations is because their revenues are not enough to cover their expenses, and they are relying on borrowing from related parties. It is a clear picture of a company burning through cash. This is another important and worrying part of the report. They admit that their disclosure controls and procedures are not effective. This means they don't have strong systems in place to make sure all the information they share is accurate and timely. They blame this on limited resources and a lack of financial expertise. They're calling these material weaknesses, which is a strong term. It is a sign that the company's internal controls are not robust. This is just a list of supporting documents. It is mostly standard legal and corporate filings like their articles of incorporation and bylaws. So what is the bottom line here? Transit Pro Tech Incorporated is a company with an interesting business idea in the rail safety technology sector. However, their financial situation is very precarious. They are losing money. Their debts are growing, they have a substantial shareholder deficit, and they have very little cash on hand. They are heavily reliant on funding from related parties, which is a common strategy for startups, but carries its own risks. The admission of material weaknesses in their internal controls and disclosure procedures is also a significant concern. The company's future hinges entirely on its ability to secure substantial additional capital, while they have a license agreement with BYD for revenue in China. The drop in royalty income and the overall increasing losses suggest that the business model is not yet sustainable on its own. The company explicitly states that there is substantial doubt about its ability to continue as a going concern. This means investors should be extremely cautious. They need to see a clear path to profitability and a significant improvement in their cash position. Right now, the story is one of potential innovation battling against severe financial challenges. Alright, that is our breakdown of Transit Pro Tech Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can turn things around, or is it a risky bet? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community, linked in the description below for more discussions and to connect with other viewers. Thanks for watching, see you next time.